welcome to this May edition of Amundi's Market Review. Equity markets sold off in April, weighed down by fears of renewed lockdowns in China, by the ongoing Russia-Ukraine war, and by the expectations of a more aggressive tightening by central banks. Global value stocks have outperformed global growth stocks, with technology names weighing on the latter ahead of key corporate quarterly results. Bond yields were up sharply on the month, with 2 and 10 years Treasury yields up to around 2.6 and 2.8 respectively. The dollar proved strong due to its safe haven status and tighter US monetary policy. On April 24th, Emmanuel Macron won the French presidential election against the National Front leader Marine Le Pen by 58.5% to 41.5%, thus removing a key risk for the markets. However, the gap was much narrower than in 2017 and the abstention rate was at 28%, the highest in 50 years. This victory will warrant stability to the European project given the President's view on a single EU foreign policy, defence and energy independence. The French President will face challenges over the next 5 years, including strengthening the French economy and its competitiveness and dealing with high dissatisfaction among the political class. This is why maintaining the parliamentary majority in the June legislative election will be crucial to implement his economic policy. Let's now turn to the more general economic outlook. We cut our growth projections while revising up our inflation forecasts. The deterioration growth-inflation mix will need to be monitored to anticipate monetary policy trends and assess stagflation risks. In detail, we downgraded our EU and China's growth projections to 2.3 and 3.4% respectively this year, while the US economy should prove more resilient at 3.1%. While the EU is being weighed down by the Russia-Ukraine war and its fallout on energy markets, China's economy will be hit by renewed lockdowns and supply chain disruptions. For central banks, we expect diverging paths, as they will be facing a key dilemma while dealing with stagflation risks. The Federal Reserve in the US should hike rates further, and we expect the Fed fund rates at 2.50 by year-end. The Fed must choose between killing inflation at the risk of triggering a recession now, or buy more time for nominal growth to increase, paying the toll later. They may sway towards the latter. On one hand, the European Central Bank should lift the deposit rate out of negative territory in 2022, while keeping as much as flexibility as possible. On the other hand, the People's Bank of China should keep its accommodative bias. On financial markets, the bond market has moved fast in repricing an aggressive Fed stance, and current levels are aligned with our year-end targets. We adjusted the duration stance statically and reduced the short duration position. We remain cautious on credit. While we are more positive on emerging bonds, we should be supported by the stability of the US 10-year yield and improving growth gap between emerging markets and developed economies. On foreign exchange, our call is for commodity and safe haven currencies, as the rise in commodity prices should benefit the Brazilian real against the dollar, while the Russia-Ukraine conflict favors the Swiss franc against the euro. We also favor the Japanese yen against the euro. Equities remain preferred over credit at this stage, but within equity selection is key. The approaching corporate earnings season appears more challenging for Europe, for which we keep a short relative bias versus the United States. We believe that a combination of value and quality stocks should be the best way to find opportunities in names that could have stable earnings and be less sensitive to rising rates. To sum up and conclude, as the great asset repricing unfolds, investors should be ready to adjust their allocation to deal with inflation. So far, most of the repricing has taken place in the bond markets. We expect more to come on the long-term rates and in the most fragile equity markets, those where recession risks are on the rise, such as European equities. However, market divergences will offer opportunities to calibrate risk towards the most resilient areas. Thank you for listening. Please keep safe and see you next month for another market review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น